Hi everybody, welcome to another update on Stock Screener. I got a request to look at Canacol Energy. Maybe natural gas is bottoming out. It's currently at minus $1 per MCF, which is of course not true, but looks like it could be a bottom at some point. Maybe next year it will go back up. So Canacol Energy is natural gas. I see it has cratered by 70%. Is it a buy or not? That is the question. So as always, we are going to use our template to evaluate EV to free cash flow. And then we create an NPV flowchart. So let's fill everything in. Presentation. I know nothing about Canacol Energy, so it's a journey. First of all, shares outstanding. 34 million. I don't see any fully diluted share count here, so let's use 34 million. Share price, and we are going to use US dollars. 4.86 divided by 1.35. 3.6 US dollars. So market cap 122. That's correct. Debt looks like they have a lot of debt. Let's check the debt. Current assets 150 million. I don't look at this. Non-current assets are to me 0. And then liabilities 881, a lot of debt. So this is real debt. So 151,882. 151 plus 882. So we have an enterprise value of 850. And this is the enterprise value M. So 850 million. Important, 850 million. You would think this is a cheap market cap, 160 million, 150 million. But what many people don't look at is the debt. And the debt makes this company go to 850 million. So use 850 million to evaluate this company. Do not use 150 million. That's the first mistake a lot of people make. Quite a lot of debt. Okay, it looks like this is only a gas producer, but why do they say equivalent? We will have to see. NPV around 1 billion. Reserve life 5 to 10 years. 5 to 10 years reserve life. No. life 5 to 10 years. So take that into account. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So I will give it 10 years, but do not count on it to go higher. So we end it here. We end it here. So this is going to be yellow. Do they own it 100%? I don't see anything else. Magdalena. Okay. There's a bit of oil. And then Bolivia. Production is stable in Colombia. And Canacol owns 17%. And you can see that reserve life is dropping. It's now 7 years. So this trend is not that good. Take that into account. They are running out of gas. Realized gas price is 6 to 5. I don't know why it is at 5, because the gas price is much lower. Fixed price. 1 to 12 years. Interesting. So they get $5 for their gas. And it goes up to 2% per year. But we need to look at the contract terms. This is important. I don't know the contract terms. So let's give them $5. $5 per MCF. Okay, natural gas sales. There's no oil, so it's basically 98% gas at let's say 170 mmscfd. Not sure what standard cubic feet. 1000 MCFs. So 170,000 MCFs in BOE. So 170,000 MCFs per day, right? That's a lot of gas. Okay, 170. CapEx is 100, let's say 150 million. 150 million. Around $5. 5.4. Okay, I'll give them 5.4. And in the CapEx, we have admin, exploration, development, okay. Debt maturities coming online only in 2027. Important to know if they can pay the debt. Interest rate pretty high, 15%. Bolivia, not sure what this is. They are entering Bolivia. So they will be having production in Bolivia next year, targeting 120 MCF per day, but only in 2030. Somewhere here, Bolivia online. Yeah, online in 2025, but 100 MCF from Bolivia. Yeah, I will give 150. Gas is apparently very high in Bolivia, 12 per MCF. I don't understand why it's so high. But yeah, it's not in production yet, so I won't add it to the NPV flowchart yet. It's all talk. That's it. Let's look at the financials then. What's the interest payments? Year ended. Net finance expense 56 million. Okay, 56 million. I will take it that they will pay it off. General and administrative 33 million. Then we have operating transportation. Okay, depletion 75 million. That will reduce the tax a bit. Revenues net of royalties and transportation. I will just remove this. This is nothing, 600 barrels per day. So total BOEs per day around 30,000 BOEs per day. Well, I can add it 6 to 7 BOEs per day. And total production 30123 BOEs per day. And that gives this 170,000. Yeah, it's 168,127. Okay, 0 here. Let's see if it matches the revenue a bit. So let's say we have $5, let's say 5 times natural gas production per year, then we have 306 million revenue. 315. Okay, it's about the same. So they got 4.39 for the price, and for oil they get 13 netbacks. I'm looking for the costs. Natural gas royalties 6.4% until 20%. 9%, 20%, 17% natural gas royalty rate. Okay, so I will use 17%, right? 17% royalty, which is B20. So 1 minus the royalty rate, 17%, as it is stated here. It's about 15 million expense, 15 million on 50 million per year, 60 million per year of the 300. 60 divided by 300 is the, yeah, it's about that amount. Realized prices. They get $6.48 for the oil. Not sure why 48. They don't get a lot uh, of money for the oil. So $6, 5.4. Okay, so we use 5.4, and for the oil we use $30 less than Brent. $30 less than Brent. So we say 30 less than Brent. Not that it's so important. So it's around 56. Doesn't make a lot of difference. Yeah, they don't have that much oil. If it goes to 70, doesn't change a lot, okay? So mainly gas. And the average is 34.7. So 34.7 was in December Q4. Still waiting for the costs. Okay, so these are the operating expenses. Per BOE is $4. It was 2.5 for the year, but lately it has gone up to 4. This is interesting. Costs have gone up a lot, up 50% costs for the natural gas, increased 100%. Why? Delayed maintenance, water treatment. Yeah, what are we going to use? Are we going to use 4 or 2? 2.5. Let's use 4 in case we need to be conservative. 4. It was 2.5. Okay. 4. It was 2.5. Does this change a lot if I use 2.5? Doesn't change a lot. Still 0 free cash flow. So it doesn't even matter. Revenue 6. Royalties. Okay, so the gas revenue 6 minus 0.6 and royalties gives us 4.39 net back. Yeah, but this is for gas. Per BOE and what am I looking at? So 34. Yeah, $6 per MCF and per BOE is 34. So the costs are one tenth of that. So this is 1/10 of that is then 4. I mean, this is a very low cost operation. Okay. They get $6 and the cost is only 0.6. So a lot of netback. There's a lot of netback. From the 6, they get 4. From the 48, Yeah, net of transportation expense. What is the transportation expense? $48.42. That's for the oil. They're making it difficult. So 34.7 net of transportation. Yeah, that's net of transportation. And here we have the transportation expense. 10 million transportation expense. Let's add that here. $11 million. But this cost is here net of transportation. Okay, we have the royalties, we have the operating. But they are using their prices. Average sales price net of transportation. So the prices that we get here is net of transportation. Okay. So this is gas price net of transportation. This is all-in sustaining costs operating only. Operating only, okay. Royalties I have added. And then we have general and administrative expense of 33. I have added that as well. So the 33 is going to be deducted here. Finance as well. Yeah, stock-based compensation. Is that important? Yeah, actually, yes. It needs to be added. So 4 million. Plus 4 million. It all adds up. Income tax. I thought it was 40%. Let's see. It doesn't make any sense. Income tax 23. A lot of items here. Okay, the tax rate is 35%. I think it's 40% now. They've increased it in Colombia. I'm just going to use 40%. Okay, so do we have everything? We have that capex, yes. Netback is -4. Interest, yes. Tax. Market cap, enterprise value, share price. Yep, we have everything. So let's create the NPV chart. Price production is going to be stable for 10 years, I think. AISC is not 4 because this is per MCF. Actually, this per MCF. No, this is per BOE, so per BOE 4. I can use 4. Price per BOE is 34. 34.7. It's about the same always because the price is basically the same. So 34.7. AIC 4. Production capex. SG&A is 37.3. Interest payments, depreciation, tax rate. So they do have earnings, a lot of earnings, but look at the capex, 150 million. If this were 0, then there would be earnings, but with this capex, they have no earnings. This is the problem, capex. So the main problem here is capex. It's always capex. So what the capex? Admin, ESG, exploration, because they don't have a lot of oil, gas, I mean. So they need to explore a lot and maintain the plants and transportation and development. So if this stays like this, then we have a problem. They have no earnings. You can see that here as well. No earnings, 0. With 700 million in debt. 700 million in debt that they can't pay off. Okay, we have revenue minus royalty, costs. Yep. Production of 10 million comes from here. Production is not going to rise because you can see it's flat, flat, and flat. So it has not risen. It was rising and then it was stalling. Capex will probably keep on going because they need to drill. The reserves are not going up, so they need to use more capex. SG&A, a lot of debt interest payments that they actually cannot pay off. So I will keep it at 50 million because they can't pay it off. So that makes it even worse. They increased taxes in Colombia. EV to free cash flow negative. This is not a buy to me. This is a really big problem. Outlook. It's not even approved. So if they don't get approval, it's not going to work in Bolivia. If they reduce capex, then they will run out of gas and cannot pay off the debt. This is a really big problem. I will not be buying this at all. And this yield will probably go to zero. It's what it is. They already got their $5 per MCF, so it's not like this can go higher. If the natural gas price goes up, it doesn't mean anything because they already get $5. So this is not a play on natural gas because the price goes up and the contract price will stay the same. Even at that price, it's zero free cash flow and they have plenty of debt. Even if this goes to 7, it's still not enough to go to the enterprise value. I need at least it to go to here. Should be 9. Yeah, should at least be 9. But it's not going to 9 because the contracts are plus 2% per year. So this has a big problem. Maybe if costs go back to 2.5, let's see what happens when costs go back. It's not going to do anything. Why? Because the costs are already this low, so it's not going to matter anything. They already have a huge netback. It's a profitable operation, but the capex is too high. And they do need the capex or else this will fall off and then we're in deep trouble. So they're in trouble and will not get out of this trouble. Is due to the debt. If they didn't have any debt, it would look a bit better, but still not good enough. Okay, that's the conclusion. This will probably go to 0. It's not good for Colombia, but it's what it is. I'll see you next video. Bye.